All right, let's get started. We'll work the 3 questions from chapter 5 first. And I have my 3 graphs here. Let's see, let me make sure. Oh, the mic's working. Oh, I gotta share this, so sorry. Okay, I want to share. Oh, I was sharing it. Come on, we're on desktop. Never mind, I give up. Okay, anyway. This is problem 11, and you can see that the crossover rate, where we move from favoring one project to the other, is 10.73%, which is also the IRR of the differential cash flows. Okay. And so you actually have 3 distinct zones here. You have, let me move that over a little bit. Let's see. Oh, that didn't work. Oh, here we go. Oh, look at that. Okay, so 3 distinct zones. From a 0% cost of capital to a 10.73, we would favor investment B. From 10.73 to 13.07, we would favor investment A. And then any cost of capital in excess of 13.07%, we would reject A and B. That's the purpose of these graphs. They'll show you this. And the last question asks, you can see that anytime the cost of capital exceeds the IRR of the differential cash flows. So B minus A, 10.73%. So when the cost of capital exceeds 10.73%, that makes your profile for the differential cash flows go negative. At the point where the differential cash flows begin to have a negative NPV, that's the point at which you would favor project A over project B. And the graph shows that clearly here. You can see that this teal looking line, once it crosses into negative NPV territory, that's the same exact point at which you would favor A over B. Right. Then the second one, okay, I guess we can start that out by just reinforcing one more time that there's no such thing as differentiating between projects by choosing the one of the highest IRR. No such thing. Right? So how can I appropriately use the IRR to make a correct choice? And the way you do that is, I guess the first question they're asked, why don't we choose the one of the highest IRR? And the reason being, of course, is that it does not necessarily lead to the highest investor wealth. So in other words, it doesn't lead to the highest NPV. All right, so the way you'd use it, IRR to show which of these investments to choose is you'd have to go into the incremental investment. And is the IRR of the incremental investment higher than the cost of capital? Well, in this case, it's 10% IRR and the cost of capital is 9. So therefore, you would accept this incremental investment, which means that in effect, obviously B is not an issue. It's well over the cost. The IRR is well over the cost of capital. So should I make an additional investment? Well, if you choose project B, you would in effect reject a project that has a positive NPV, don't you? Because A, from a cash flow perspective, is equivalent to B and A minus B, isn't it? So you would, if these were millions of dollars, you would reject the opportunity for your shareholders to gain $2.76 million if you were to choose B over A. Okay, and then we're supposed to show that, again, you make the correct decision the first time, no questions asked if you just simply do the NPV. And with a cost of capital of 9%, we show that the A project has the highest NPV. Yeah. Then on the last one, okay, if you were to graph these, the graph would look something like mine, I would hope. And technically, I'm saying technically, okay, you would choose a the second shift once the cost of capital exceeds 21.13%. And then you would stay with that 2 shifts until the cost of capital reaches 78.87%, at which time you would technically go back to 1 shift. Okay. So obviously this is a positive NPV investment as long as the cost of capital stays below 18.8%. So they would be pleased that they made that investment if it's 18.8% or less, the cost of capital. But this question is asking, when should you add the second shift for which cost of capital? And again, the realistic one is the 21.13%. I get, a cost of capital of 78.87. We're talking in the abstract by then. There's nothing in reality there. The cost of capital just can't be that high and have any kind of a somewhat, at least semi-thriving economy. So, but if you just said greater than 21.13%, that's close enough. That's close enough. I was trying to figure out here why my, I think I interjected these right in the middle here. I think that's what happened. I'm trying to figure out why my graph doubled back on this part up here and up here and here. I think I didn't quite do it correctly, but this is the general idea. All right, any questions on chapter 5? So let me go to my conversations. Does not look like it. All right, let's move then, if we can, into chapter 6. So if you would pull out the lecture notes from chapter 6, we can get started. All right, so in chapter 5, we went through the methodology itself, the NPV method. The NPV method required a cash flow zero, any number of operating cash flows, and finally any kind of capital recovery at the end. All right. These are all given to us in the chapter 5, but now we will have to estimate the cash flows. That's what we'll be doing in cash flows in chapter 6. Right. So we'll start out every NPV project, every NPV analysis has a cash flow zero. All right, and it's the cost of the equipment, the cost of the real estate, whatever the investment involves, plus any additional working capital that the project requires. And you'll notice in the problems that I've assigned you, it just says working capital. Well, what does that mean? Okay, so I've constructed a partial balance sheet. And you notice on the left side, I have cash, receivables, and inventory. On the right side, I have payables and accruals. Okay. So working capital are basically any of those components in your balance sheet in the upper portion, the short-term portion, which change what we call spontaneously with sales. In other words, or with revenues. So you tie them directly to revenues. And so, for example, if you had an increase in revenues, you would expect your receivables to increase. You'd have to carry an additional inventory to meet this additional demand, and so on. You'd probably be making more purchases, so your payables would go up. You'd have more wages, more taxes. Your accruals would go up. So therefore, all of these tend to follow revenues. Right? What's missing here would be any kind of marketable securities, right? Or any type of notes payable that has a term of 1 year or less. And the reason being that what would marketable securities be? Well, they would be a temporary investment. Okay. So that they're not part of operations. Those are part of investments. What would a short-term note be? That would be a financing option. That's not part of investments. That's part of your financing. So we just want working capital to represent the current assets and current liabilities that would change spontaneously with operations. Right? So another general rule would be that if it bears interest, you don't include it. So obviously the short-term investments you don't include here, and then the over here the notes payable you don't include because they bear interest. So if it's actually a financing alternative, it's not in here. If it's a investing alternative, it's not in here. So look for items that bear. Now, none of the problems in your Chapter 6 assignment will give you any details of working capital whatsoever, except they'll just say working capital equals, or the project will require working capital of. So when they say working capital, this is what they really mean. Working capital is the difference between the operating current assets and the operating current liabilities. But you'll just get one word or one phrase there. You'll get operating capital. Or in some cases, it'll say operating working capital. Now, what if I were valuing this company and they had some marketable securities? What would I do with those? Well, they'll still have value. They're just not operating. So what you'll do is you'll take on one of your valuation models. You'll find the value of the company's operations, and then you'll add back any non-operating assets. All right, and then on the other side, your accounts payable and your accruals. Well, you might have a note payable here. Well, that's captured. Anything that bears interest is just captured as debt. So when we value a company, we reduce the right side of the balance sheet just to debt and equity. That's all that's on there. All right. So let's get back to estimating cash flows. Here is the general equation. So it's the revenues less operating costs less depreciation. Okay. So that would be your before tax, and then times 1 minus T converts this to an after-tax value. And then we add back depreciation. Why do we add back depreciation? Because it's a non-cash expense. And then we deduct any change in net working capital, net operating working capital, working capital. Okay. All right. So here's your definitions. I hope you see those. All right. Now what I do, I've done this since I've been teaching this a couple of years ago at least. Yeah, anyway. If we take this revenues minus cost minus, look what happens here. I take my revenues, take out my operating costs, and what if I happen to be in a situation where I have a very large depreciation? Now what happens? This difference can be positive, and if depreciation is higher than this difference, everything inside the parentheses here becomes negative. And what does the student do when they see negative here? Well, you can't have a tax if you have a negative income here, so they've changed this to 0. Okay, that's totally incorrect. I can show you an example of that shortly, but What I do to eliminate that issue is take out this non-cash expense, take it out. So I pull this out, and that leaves me revenues minus cost, those are cash items, times 1 minus t. Okay, then we get a negative d, so 1 times minus d, that's my minus d, minus t times minus d, that gives me this term, and then we always had a separate d term up here in this equation. So obviously these two will cancel, and you'll see that this, and what's left here is t times depreciation. Now, does this make it obvious that depreciation will never hurt your cash flows? Will always add to your cash flows, doesn't it? There's no confusion here, is there? Higher depreciation we can equate with higher cash flow estimates, correct? Okay, so let me just point this out with a quick example. So I have company A, company B, they're identical when it comes to revenues minus costs. Company A has no depreciation, company B is 40. So we get our pre-tax income. This one's 100, this one's 60. Taxes at 30%, this one takes out 30, leaves income of 70. This one takes out 18, leaves income of 42. So you might recall, especially those of you who are doubling in accounting, that we have any number of sets of financial statements that companies keep. You know, one for tax purposes, one for reporting, one for internal. So for reporting, what's net income? Well, that's your earnings. So you might want to use this one to report, right? But any analyst who is valuing your company would never stop here. They would go through and actually calculate your cash flow, right? So what's this? Okay, one difference between these companies, right? Just the depreciation. It's the only difference. So what's that worth to a company? Well, as you can see, when I calculate the cash flow for A using this equation that I developed above, you can see that the last term, 30% times 0 for company A versus 30% times 40 or 12, and that's the difference, isn't it? So 82 minus 70, that difference is 12. I can account for that difference by this 12 we see in the equation, t times depreciation, which we call the depreciation tax shield. All right. So 3 components of a evaluation of a project. One would be the initial cost, CF0, then your operating cash flows, which is what we're estimating here. And then finally, there's a capital recovery or the terminal cash flow. So when this investment is over, there might be some recovery of the initial capital. For example, you may have equipment that you may be able to sell that still has retained some market value. All right. And so anytime that you include a salvage value as part of your project cash flows, you have to take into consideration the tax effects. Okay, and I'm pretty sure this isn't in your book, but I mean, it's the only way to do it. And your tax cash flow, I don't say tax, do I? I say tax cash flow, because look what happens here. So I'm taking minus t times the difference between the salvage value, that's the market value, minus the book value. In other words, you would salvage it, sell it at its market value. So market minus book. Okay, what happens if the salvage or market value exceeds the book? Well, in that case, this is a gain, and it's treated as ordinary income, and it is taxed at a rate of t. So we'll get a negative cash flow here, won't we? What happens if the, now, you know, sometimes when you use straight line depreciation, you take the you take the acquisition cost and subtract the salvage and divide by the number of years. Well, if you do that, then at the end of the project, the book and the salvage are identical. So therefore, the salvage and book being equal to each other, there is no tax cash flow. And one last possibility, and I think we see this in, especially in something like electronic equipment, whereby it depreciates very quickly, and the book value might very well exceed the salvage value. So if the book is higher than the market at the time you sell it, well, in that case, you will realize a positive tax cash flow from that sale. Okay, so if you just follow this equation, stick with it, and you'll be all right on this. All right, let's do a quick example of this. And okay, why don't we let's copy this this example sheet here into an Excel file. Let me get one ready first. All right, let me get a new one here. Oops, doggone it. You know what? That didn't hurt. Oh yeah, by the way, I was going to show you how to draw one of these profiles without ever using Excel. And I try to do it freehand. You can see this is no thing of beauty, is it? But anyway, let's skip that. You know, I have these two icons. One is a new file. One is a close the current file. And I about half the time grab the wrong one. So now I want a new file. And so I have a new file. And I'll do my pasting here. Okay, so we'll copy this. And we'll drop it into that Excel file. All right. So I'll do that, and I'll blow it up so you can actually see it. All right. All right, now let me explain a little bit here. It's something you want to do in Excel is leave your values so that you can access them. So in other words, what if I said here, working capital will be 1,000 immediately, and what if I write in here, say, I typed out 10% of, oops, of next year's sales. All right, now do you see what happens here? I don't have access to that, do I? It's in the middle of a sentence. Okay, so what I did, rather than go through all this, what I did to make that number accessible to me, I put it here. So this should be reading $1,000 immediately and 10% of next year's sales beginning in year one. Okay, now this 10% is out here as a value, and for my calculation purposes, I can access it, can't I? So you always like to keep your numbers where you can get to them. So I want to know the cost of capital. I want to know the tax rate. Here's my depreciation factors. All right. So let's begin with our first year's estimate. So let's do revenues minus costs. Oops. Times. Let's do this first part of it. If you want to do the whole thing in one shot, you could. Well, I'm just going to break it down here if I could. Okay, so I'm going to say equals. I'll take the revenues, subtract the cost of goods sold, that's a cost, and I'll subtract the other costs. Okay, and I'll put a right parentheses on this. All right, and then I want to multiply it by 1 minus the tax rate. So 1 minus, and I'll go up and get this 35% tax rate. And of course, I'll lock it because that will not change throughout the analysis, will it? So I do an F4, Command T, function F4, whatever it takes, type in a couple dollar signs. All right. Okay, I have that. Now, again, Excel doesn't lose decimals, it just simply doesn't display them. So I'm going to keep my numbers clean here. Okay, and then our tax shield. T times depreciation. All right. So we'll say equals the tax rate. And I'll lock that, of course, because it won't change. Times depreciation. Okay, what can I depreciate? Okay, depreciation involves your capital assets, and there's always exceptions to the rules. Like, for example, if you're an S corp or an LLC or something like that, you can take a huge deduction on your capital equipment the first year. Okay, we're not getting into these exceptions, so we're gonna work as a C corp, and therefore I can only deduct the cost of my capital assets, not the working capital. Okay, so I'm going to depreciate just the initial cost. Okay, and then I'll lock that. Okay, so can I take 100% of it the first year? I cannot. I can take 33% of it. Okay, and so I'm taking $10,000 times 33% times the tax rate. So T times depreciation. This is what I get. Do a little quality control. So 35 times 10 times, yeah, that looks good. All right, and then let's do our working capital. Okay, and it says initially $1,000. So let's go get that 1,000. Okay, and what do we do after that? It's 10% of next year's sales beginning in year one. So I'm going to go here. So we're going to increase that to what? 10%, and I'll lock that, of course, times next year's sales. You know, that I won't lock because I will be changing it as I copy across, won't I? Okay, now what's important when it comes to working capital? Working capital is a difference in assets and liabilities, correct? But they're on the balance sheet. So therefore, a balance sheet item is never a cash flow, but a change is. So we're going to do our change. Change in working cap. So we're going to say equals the 1289 number, and we'll subtract the 1,000. So we've upped it by what? 289? Everybody agree with that? And I have a mistake here. I can see it from here. Oh, I don't though. Okay, all right, maybe we're all right. Let's try it. Okay, so let's do our cash flow. Let's do our operating cash flow first. And so that would equal R minus C times 1 minus T, that's here, plus T times depreciation minus our change in working capital. Oh, I got it right. All right, let's take a pause and see what kind of help I can offer here. Okay, questions? Oh, can someone give me, oh, I'm sorry. Sorry. Can someone give me the equation for T times D? I'm not sure, minimum cell C11. We can look at C11. That's not too hard to do. Show the working capital too. All right, we can do that. All right. Okay, so we took the tax rate, 35%. And how much are we depreciating in year one? We will be depreciating, we're using the MACRS schedule, correct? So we'll be taking 30% of the 10,000. So my depreciation tax yield the first year is 33%. Oops, can't do that. Is 33% times 10,000 or 3,300 times 35%. And that's how I got this number. Okay, so, you know, it would be 10,000, oops. It would be $10,000 times 33% times the tax rate, 35%. Oh, I got it. And I think something else I was supposed to answer there. Let me look. Oh yeah, working capital. Let's do that one too. Working capital. Okay, so working capital, this is given. That's the initial amount of working capital. So that will be sufficient working capital to support operations in year one. So we have this at the beginning of the year, right? At the beginning of year one. And then what happens during year one? We have to build it up to be sufficiently large to support year two's operations by the end of year one. So the story here, now again, these stories change all over, but we're going to say that 10% of the following year's sales. So that's where I got this number. I said that I'm going to take 10% of this 12,887, and that's where I'd like my ending working capital to be by the end of year one. So what I had to do is build this up from 1,000 to 1,289, or a difference of 289. So that's your delta working capital. Okay, and then I take my components, revenues minus cost, plus T times depreciation, minus any increase in working capital, and that's what gave me this final number. Are we okay on this? Got it. All right, it's important to get these numbers, and it's good to resolve any issues you might have right now. Okay, C11. Let's look at the cell C11. I can do that. C11. Okay. Yeah, so this is the tax rate times the depreciation. So it's 33% of 10,000, and I've locked the 10,000, right? That's the amount of depreciation the company will take in year one, and I multiply that times the tax rate of 35%, which I locked. How did that go? I'm losing this. Let's see, B4 times D7. B4, 10% times D7. That's the amount of working capital. That's right. That would give me C12. And that's correct. So it's the story says that it will be 10% of the following year's sales. And that's correct. What am I not answering? Let me see. Got it. All right, wonderful. I'm not sure what this question is. Caret C12.
Professor
sure.
Ogden, I was just saying that was the formula for C12.
Oh, I see. Okay, thank you. Yep. I'm with you. Gotcha. Okay, so that's helpful. Thank you. All right. Well, if everything's locked correctly, Then, you know, I remember previous semesters, I'd use an example like this, and we'd have a piece of paper in front of us and our financial calculators out, and we just write until we get this done. Well, here, you know, through the magic of Disney, we just copy this across. And we have operating cash flows 1 through 4 estimated now. Okay, do we want to see C14 again? Is that what we're asking? So C10 plus C11, so R minus C times 1 minus T plus T times depreciation, and then subtract the change, the increase in working capital. Did that answer that question? All right, nice. So are we ready to go now? We just have to do our terminal cash flow, and then we will be ready for the NPV analysis. Okay, so let's do our terminal cash flow. In a terminal cash flow, what happens at the end of the investment period? Well, we will salvage some part of our initial investment in the equipment, and according to the story, the salvage value, and that's really just the market value. So if you can come up with an estimate of the market value 4 years from now, that would be your salvage value. And by the way, if you have somehow the ability to do something like that, you might have a good future in the leasing area, because in the leasing area they call that the residual value, and the whole secret to writing a lease is, if you're writing the lease, is to nail down that salvage value, because we can all estimate what it costs now. What will it cost? What will it be worth in 4 years when I sell it? You build all that into your lease, to your lease contract. So yeah, that's you got a bright future if you can find numbers like this, if you can actually do it. All right, and so I'm going to salvage this thing for $2,000, and now I have to check that against the book value. And this is one of the nice things about Excel. You know, you're doing this on paper. This would take some time, but let's go back just for a moment. This is just for clarification, not necessary, but oh my goodness. Well, maybe I can't even do it. Okay, but one thing to recognize, if I come over here and I add these depreciation factors, that's 100%, isn't it? So over these 4 years, I have reduced the book value of the asset by 100%. Okay, so it currently has a book value of 0. It has a book value of 0. So we'll do the tax cash flow. Of course, that is the minus T times salvage value minus book value. Now, this might appear that I'm taxing the entire salvage value, but I'm really not. It just so happens that the book value is 0. Let me check for a question here. How I got D12? Okay, let me go back, see if we can find that. D12. D12. Yeah, it's just 1 year ahead, right? 10% times 1 year ahead. So this one was 1289. That was 10% of 1288 and so on, right? 10% 1 year ahead, 10% 1 year ahead. I wonder if we forgot to lock that that B4. We got to do that, remember? All right. So let's put that over here. Equals minus the tax rate times the difference between the salvage minus the book. Well, in this case, the book is 0. Book is 0. Okay. It might appear that I'm taxing the entire salvage value. Well, I'm not. I'm taxing the gain over the book. In this case, it is the whole amount, but that's not always true. We'll see that in an upcoming example. Okay, so in this case, all right, so then let's do cash flows for NPV. And let's finish this one off. Okay, so we have an operating of 16,895. We will salvage for 2. We'll pay a tax of 7. So basically, all I have to do is do a little auto sum here. Do you see that? These last 3 numbers? I get 18,195. Right? Now you can be prim and proper and get these other cash flows, or can I just, knowing that nothing's happening in these 2 rows, I can just copy this backwards, can I? Just be efficient. Okay. Or if you want, I can say equals this one. And do the same thing for the next 3 years, however you want to do it. I tend to follow the motto, get it done. Question somewhere.
What numbers did you take the sum of? What column?
The bottom 3 here.
Oh, okay, gotcha.
The 16,895, the 2, and the minus 7.
Okay, thank you.
Yep. Okay, and then what's our cash flow 0? Well, we had to put up $1,000 or $10,000 for the initial cost of the equipment, whatever it might have been, and then we also put up $1,000 of working capital. So this is cash flow 0. These are cash flows 1 through 4. Now we are at this point have everything in place to do an NPV analysis. So let's do an NPV. And just for purposes of demonstration, let's do an IRR. Although it's obviously not in any way required. Okay, so equals NPV. We'll catch our rate, 20%. Catch our cash flows, beginning with cash flow 1. Close the function. Add back the initial cost, which is displayed as a negative number. And of course, Excel is always willing to give you more decimals than you could ever need. And I'm always willing to reject it. All right, so this is a positive number. We would therefore accept this project. Now, what do I know if I do the IRR? What will I get? I mean, approximately. What do I know about it right now? Do I know the exact number? You know, I'm no mental giant. I can't figure it out in my head. But what do I know about it? Okay, we'll just look at it. Uh-oh, got a question here. Sorry, I missed that. What are we asking about? F16? Let's see. F17. Let's show both F16 and F17. All right, let's go back. F16. Okay, so that's minus T times the market salvage minus the book. Now this is something I'm very uncomfortable doing. I typed in a 0, didn't I? I usually don't like to type in numbers. Okay, and then F17, it's just the sum of these last three. So, actually, you know what I can do here if you want me to? Put that right here. So it's the sum of this one, and this one. Okay, and what was this one again? We can get that. So minus T times D times salvage minus book. Anything else? Have I answered everything? Sorry, B17. Oh, okay, I missed. Let's go back and do B17. B, Bubba, 17, yeah. Okay, I'm estimating cash flow 0. And that would be the initial cost plus any change in working capital initially. Is that okay? Did I answer the question? Oops. Are we all right? Okay, well, hearing no objections, I think we'll move on. So this would be an investment that this company would go through with. And we know this IRR will exceed the cost of capital. I don't know by how much, but it will be at least 20%. So we'll just do an IRR here real quickly, just to verify what Chapter 5 told us. And now, okay, here when I had the thousands of dollars, I took off the decimals, correct? Now when I get to a percentage, I will add 2 decimals. You see, we don't know if that's 27%. That's anything from what? 26.51 to 27.49, isn't it? So make sure when you do a percentage, you add 2 decimals so we can see where we are. All right, let's go back to the Word document and move on to our next example. Okay, so I think I got a little okay, we did all this. Maybe a little different format than I'm showing here, but it's the same answer. So 2413, and you notice down here I didn't even show the IRR. Would not be necessary, but you can certainly do it. All right, now let's go back. The discount rate we apply to the cash flow estimates is the WACC. So this is the WACC. Debt to value times RD times 1 minus T plus equity to value R minus times the cost of equity. And these are all defined here. And this is something we will get into in much detail in Chapter 19, which is our next chapter. So we will kind of buzz by this right now. I'm just trying to say this is the discount rate we would use. Now you'll notice when we calculated the cash flows, do you see that if I had a company that had used some amount of debt financing, would it not have an interest expense? Okay. And did you see anywhere in our cash flow estimates interest expense? I mean, wouldn't an interest payment be a cash flow? Well, yes, it is. But I guess the point of all this is we are showing the cost of debt as part of our discount rate. Okay, so if you would show it here in your discount rate and then also subtract it in your cash flows, you'd be accounting for it twice. So that's why we don't. Okay, now another question real quick. Do I have that here? Okay, yeah, let's ask a question now. What if the project finished at the end of year 2 instead of year 4 and the salvage value remains 2,000? Let's go back to this one. So we're going to finish this after the second year instead of the fourth, and let's say the salvage remained 2,000. This is a what if, right? We didn't do any of this. So we're going to salvage this for 2,000 at the end of year 2. This is a what if. What if this project were 2 years instead? All I want you to do is focus on the tax cash flow. Okay. All right, and what would that be? Okay, so it would be, let's stay with the equation, minus the tax rate times the difference between salvage. Well, we just assume that we can still sell it for 2,000 minus the book value. Okay, what's the book value at the end of year 2? Well, if you go back up here, you took 33% the first year. We took 45% the second. So what remains? What remains is always any of the factors you haven't taken yet, whether this is on a 7-year MACRS schedule or a 3-year or a 5-year schedule. So we haven't taken 15 plus 7 or 22%. Everybody see where I'm getting 22%? Okay, so if we sell this at the end of year 2, we did not take the year 3 factor, we did not take the year 4 factor. So what we'll do, okay, and I think I can keep that. So we'll take the year 3 factor. You know, I'll just write these out. I can do that for you. We'll take the year 3 factor plus the year 4 factor, haven't taken either one, times the acquisition price. Okay. So let's see what our tax cash flow turns out to be. Oh, no. Don't ever let Excel correct you. Okay, why am I doing? Oh, I need another parentheses. That's on me. Okay. So, minus T times salvage value minus book value. The book value would be the remaining factors. So 15 and 7 times the acquisition cost. And so the tax cash flow in this case would be a positive 70. So we actually sold it for less than book value, didn't we? Right, so what this amounts to, it's minus 35% times, and then the difference, 2,000 minus, and then it would be 2,200, wouldn't it? 15 plus 7%, That's 22% times 10,000, which would be 2,200. And that's how we got the 70. Follow? All right. Well, let's move on. All right, let's, okay. All right, now another format you can use. And this is the one, if you like to hug your book and read it several times, this is the way your book would do it. They would follow my original algebraic equation. So they're going to take revenues minus costs, so 523 minus the 837 minus the 22 minus the depreciation. Okay, and that'll give them this number. And then they're going to take out the taxes. So 35% times this number gives you this. And this becomes the one, and this is what it is after tax. So 58814 minus a minus 2035. And yeah, this is where this gets confusing, isn't it? You get the minuses. Anyway, you add back depreciation. So revenues minus costs minus depreciation times 1 minus t, and then take out the change of working capital, and you eventually get right back to where we are. All right. And so this is what your book would be doing. If you were working this problem in your book, this is what your book would suggest. And I prefer not to do it this way. That's just me. I mean, whatever, if you'd prefer to, to do what the book shows, that's fine with me. You get the same answer. So we'll get exactly the same thing. All right, so let's do another example of the Adams family. Get that? Adams family, not Adams Company. Anyway. All right. So the Adams Company is considering non-destructive testing to replace its current quality control method in which they destroy samples. Excuse me. Excuse me. A magnetic resonating machine would make non-destructive testing possible. Costs $170,000, plus they have to invest $8,000 in inventory. Okay, where does inventory fit into all this? In my original sheet I showed you, that's one of the current assets that's in the working capital equation, isn't it? Okay, so since you don't see any offsetting values, anything on the left side or the right side of the balance sheet to offset this will be your change in working capital, won't it? So they're going to follow the 3-year schedule. I tend to do that. Okay, and it'll be employed for 3 years. And they think it'll be worth $60,000 at the end of the 3rd year. So when this project is over, they think they can recover the entirety of that inventory. So what's different about this project than of the one we've already done? It doesn't build up inventory over time. It adds some at the beginning and then recaptures it at the end. So why are they going through all this? Are we going to increase our revenues? Not a bit. So what they'll do is they think they'll save $50,000 annually on the samples they no longer need to destroy. Where I saw this done was looking for what we call hollow welds. So you take so many samples and then you slice across a weld and see if there's any air pockets in it. And this way, instead of destroying the sample, you just take a magnetic image of it and you can see if there's hollow spots. We're going to use a 20% cost to capital, and we're going to use a modern tax rate on this one since I wrote this. Should they accept the investment, and so on. All right, so let's drop this into Excel and oops, go down to this table, and let's you don't want the whole table, obviously, because you don't need row and column headings. So let's take out of this, what do we need? Oh, that's what I did wrong. Okay. Oh, don't do anything bad. Okay, there we go. Let's get our cost of capital. Okay. And do we need anything else? Not really. Yes, we do. We'll type it in. We'll get it later. Okay, let's copy this. And let's go to this last sheet we did, and let's just open a new one. Or we can just put a new sheet on this. That would work too. All right, and I'll drop this in. Whoops, didn't do that. Okay, now I'll blow this up. Let's give ourselves one more number while we remember it, and that would be annual savings. We'll put that in as a $50,000. Right? So cash flow zero, I pretty much did that one for you. 170, that's the cost of the equipment. And then the working capital, I don't know why these have to be on separate columns. Anyway, the working capital is an additional 8,000. So to start this project, the company would have to invest $178,000. All right, and let's let's do our operating cash flows. So let's do op cash flow 1, and we'll do 3 of these. And as you know, Excel will add that, change that last number for me as I copy that down, won't it? Okay, and then we will use revenues minus costs times minus T plus T times depreciation. There you go. So let's do that. First year equals. Now, how many sales do you think a resonating machine brings in? How about none? So there's no change in revenues. Minus costs. How will your costs change? They will decrease by $50,000. We better lock that. By $50,000 annually. All right. Revenues minus costs. And then times 1 minus T. Looks like it's right here. Let's make sure we lock that. We're going to copy this down, you know. Okay, and let's be efficient about this. Plus T, 21%. And what do we take the first year in depreciation? T times depreciation. What will we take the first year? Okay, we will take 33% of the equipment cost. Okay, so T, oh, very bad. Let's lock that. T times depreciation. Okay, well, right now I'm showing the cost at as a negative value, so why don't I flip the sign on that? Times minus 170. And I'm going to remember to lock that. Times our first factor. Yeah, I don't lock the factor, right? Because I'm going to pull this down, aren't I? Oh, thank you, Excel. Part of our everlasting honeymoon for the last 30 years. Your formatting. And so I get 51,281 for the first one. So there's the equation again. So revenues, 0, minus expenses, or minus costs. Expenses are an income statement item. Costs are a cash flow item. minus costs, and we're saving 50,000 annually, times 1 minus T plus T, both locked, looks pretty good so far, times the depreciation, which should be the acquisition cost, locked, and I flipped the sign on it because it's actually 170,000 positive, times factor number 1. So how did we do on that? All right, let's move on. What will I do next? It'll take me about 45 minutes to get the next two, right? How about 4.2 seconds? Just double click this and you have them, don't you? All right, and let's do a little quality control. Make sure we didn't end up on some cell we didn't want. Okay, so I'm 0 minus 50,000 times 1 minus T, that looks good, plus T, looks very good, times acquisition cost, times, and I should be into the second factor now, which I am. Looks good. Is everybody all right on this? Did I copy correctly? Right, so I hope this is kind of getting where it's starting to repeat itself, isn't it? We're doing pretty much the same kinds of things. All right, now this one's a little bit different. We started with 8,000 in working capital, and we did not build it up over the years, did we? It didn't go up each year, so there's no delta working capital here, is there? There's no change in working capital. Okay, so let's do, on the end here, terminal cash flows. Let's start out with the salvage. All right, and I'm going to call that equals, oh, do I not have that anywhere? Oh, we have to go get that. That's my fault. Let's go get that. Okay, that would be $60,000. Okay, so maybe I'll put this up out here somewhere. Oh, crap. Oops. 60,000. Okay, so our salvage is 60,000. Okay, and I'm going to give you 2 minutes. We haven't got much time here. Tell me the tax cash flow. If you can get it right, go ahead. Okay, just in general, you might remember, minus the tax rate. I'm not going to help you with this on your exam, am I? So there's a good chance to use live ammo. Minus T times, oh, look at that. I'm trying to show you the equation. Times salvage value minus book value. All right, now this has 4 factors. We stopped operating at the end of year 3, didn't we? So what depreciation are we not taking? How about 7%? So that means the book value will have 7% remaining on it because we took 33% the first year, 45 the second, and 15 the third. There's 7% remaining. Okay, so let's see if we can make this work. Minus the tax rate. times the spread between the salvage oh boy, you get it? Okay. Salvage minus, and then what's the book value going to be? Well, it's just going to be the 7% times, and then the acquisition price was 170, not a negative 170. So I will include near a minus sign to flip the sign of this 170. So market 60 minus book, which would be 7% of 170,000. And then I'll need one more parentheses, so Excel won't have a fit. Wow, that's a good one. What did I do here? Oh, sorry. This should be minus. There we go. So tax rate minus tax rate times the salvage minus the book. All right, let's see what we get this time. There we go. That's a good number. Keep the format pretty. All right, and then let's do the working capital, recovery of working capital. All right, so basically just flip the sign on it. You invested 8,000, now you'll recapture 8,000. I just add these together and I have my terminal cash flow. All right. All right, so let's put these together then. Let's do our cash flows for capital budgeting. So cash flows for NPV. Right, the terminal cash flow is a year 3 cash flow. So we're going to piggyback that right on to the operating cash flow. So here's our here we are. We're going to have cash flow 0. And then we'll go through cash flows 1 through 3 after that. So let's copy that down. So 0, 1, 2, 3. Cash flow 0, we have that above. Negative 178. Cash flows 1 and 2 are pretty straightforward. It's the 2 operating cash flows. And then cash flow 3, well, we'll have not only the operating, but we'll add to that the terminal cash flows. And just to make sure I'm going to go ahead and do this real quick, and I'll check for questions, but let's do an NPV. And so we'll say equals NPV. Our rate is 20%. Okay, so we'll highlight cash flows 1 through 3. And then we'll add back the initial investment. And we see that this one is quite negative. So what do we know about the IRR before we go anywhere else with it? Oops. Well, we know the IRR is less than 20%, but how much less? And we know that it is, we always give it 2 places, 7.64%, much less than the cost of capital. Now, a question I ask in the lecture notes is, what would the cost of capital have to be such that we would accept this project? And I hope you can see it has to be 7.64% or less. So if I come up here and change this cost of capital, say to 6%, what will happen? I will find myself with a positive NPV, won't I? I come down here, and there it is. It's very positive, isn't it? It has to exceed 7.64%. If I decide that I'm going to use the IRR as the cost of capital, what if it's 7.64? well, then I should expect an NPV of what? I should expect an NPV of 0. And Excel tells me that I'm doing it correctly. But this started out with a 20% cost of capital. And therefore, it's a highly negative NPV. In order to fund this, we'd have to get that cost of capital down to 7.64%. All right, I guess that's all we have.